Will the increases in productivity persist? It is likely that in some cases, firms achieve their productivity gains by asking their remaining workers to provide more effort. The additional gains that can be achieved in this way are limited and probably temporary. Although continuing uncertainty and financial constraints might make such firms hesitant to hire, if demand, production, and confidence pick up, they will find their labor force stretched thin and they will add new workers. However, other firms facing difficult financial conditions and intense pressure to cut costs seem to have found longer-lasting, efficiency-enhancing changes that allowed them to reduce their workforces. And some less efficient firms, no longer able to compete, closed their doors. Again, improved efficiency confers great benefits in the longer term. However, to the extent that firms are able to find further cost-cutting measures as output expands, they may delay hiring. Other factors will affect near-term employment growth as well. Business confidence in the durability of the expansion, for example, will help determine employers' willingness to hire. The current prevalence of part-time work and short work weeks may slow job creation early in the recovery period, as employers prefer to convert workers from part-time to full-time status and to add overtime work before turning to new hires. In addition, difficulties in obtaining credit could hinder the expansion of small and medium-sized businesses and prevent the formation of new businesses. Because smaller businesses account for a significant portion of net employment gains during recoveries, limited credit could hinder job growth. Overall, a number of factors suggest that employment gains may be modest during the early stages of the expansion. Let me return now to the outlook for the economy and for policy. As I noted, I expect moderate growth to continue next year. Final demand shows signs of strengthening, supported by the broad improvement in financial conditions. Additionally, the beneficial influence of the inventory cycle on production should continue for somewhat longer. Housing faces important problems, including continuing high foreclosure rates, but residential investment should become a small positive for growth next year rather than a significant drag, as has been the case for the past several years. Prospects for non-residential construction are poor, however, given weak fundamentals and tight financing conditions. In the business sector, manufacturing activity has been expanding and should be helped by the continuing strength of the recovery in the emerging market economies, especially in Asia. As the recovery takes hold, enhanced business confidence, together with the low cost of capital for firms with access to public capital markets, should lead to a pickup in business spending on equipment and software, which has already shown signs of stabilizing. I've already discussed two of the principal factors that may constrain the pace of the recovery, namely restrictive bank lending and a weak job market. Banks' reluctance to lend will limit the ability of some businesses to expand and to hire. I expect the situation to normalize gradually as improving economic conditions strengthen bank balance sheets and reduce uncertainty. The fallout for banks from commercial real estate could slow that progress somewhat, however. Jobs are likely to remain scarce for some time, keeping households cautious about their spending. As the recovery becomes established, however, payroll should begin to grow again at a pace that increases over time. Nevertheless, as net gains of roughly 100,000 jobs per month are needed just to absorb new entrants into the labor force, the unemployment rate likely will decline only slowly if economic growth remains moderate, as I expect. The outlook for inflation is also subject to a number of cross-currents. Many factors affect inflation, including slack in resource utilization, inflation expectations, exchange rates, and prices of oil and other commodities. Although resource slack cannot be measured precisely, it is certainly high, and it is showing through to underlying wage and price trends. Longer-run inflation expectations are stable, having responded relatively little either to downward or to upward pressures on inflation. Expectations can be early warning signs of inflation, however, and must be monitored carefully. Commodity prices have risen lately, likely reflecting the pickup in global economic activity, especially in resource-intensive emerging market economies, and the recent depreciation of the dollar. On net, notwithstanding significant cross-currents, inflation seems likely to remain subdued for some time. The foreign exchange value of the dollar has moved over a wide range during the past year or so. When financial stresses were most pronounced, a flight to the deepest and most liquid capital markets resulted in a marked increase in the dollar. More recently, as financial market functioning has improved and global economic activity has stabilized, these safe haven flows have abated and the dollar has accordingly retraced its gains. The Federal Reserve will continue to monitor these developments closely. We are attentive to the implications of changes in the value of the dollar and will continue to formulate policy to guard against risk to our dual mandate to foster both maximum employment and price stability. Our commitment to our dual objectives, together with the underlying strengths of the U.S. economy, will help ensure that the dollar is strong and a source of global financial stability. The Federal Open Market Committee continues to anticipate that economic conditions, including low rates of resource utilization, subdued inflation trends, and stable inflation expectations, are likely to warrant exceptionally low levels of the federal funds rate for an extended period. Of course, significant changes in economic conditions or the economic outlook would change the outlook for policy as well. We have a wide range of tools for removing monetary policy accommodation when the economic outlook requires us to do so, and we will calibrate the timing and pace of any future tightening to best foster maximum employment and price stability. Thank you very much.